Thank you, Mr. Chairman, and welcome to our witnesses. As elected representatives, we have a duty to serve our constituents, and doing so effectively requires strong public trust and confidence that members of Congress are working to serve the American people, not our individual personal gains. And as you all have described here this morning, over the years there has been an increased and warranted scrutiny over the stock trading practices of members, which has raised questions on whether our existing regulatory structure is adequate. Mr. Copeland, I would like to focus on a couple of the areas that you mentioned in your testimony. I think there's broad consensus that we need to seriously consider outright prohibition on members of Congress owning, trading individual securities. But one of the things that you mentioned is that if we are to adopt new conflict of interest prohibitions that require members to divest individual securities, that we ought to consider the tax treatment of that required divestment. Would you elaborate for us on what you are describing there and why it is important?
Yes, and there are already provisions, conflict of interest type divestment provisions that exist in law in other situations. So it wouldn't be reinventing the wheel, but anyone who's invested in markets, including mutual funds or anything else, you get an accrued capital gain. So if you've held an asset for decades, you're going to have a large capital gain. And so if you had a rule that forced divestment of your securities, and rolling an individual stock into a diversified mutual fund or what have you, you would have a large tax consequence, which in many cases could dwarf your congressional salary or other things, depending on what sort of individual you are. So I don't think it's reasonable to require divestment without not requiring that massive tax hit to serve into Congress. And so what this would do is it would roll that gain over. It's like it wouldn't be like a capital gain step up like in an estate. You would roll that over into the new security that you purchased, and assuming you purchased equal for equal, that would reduce the basis in the new security you purchased so that whenever that was disposed of, the gain would accrue. So is it a perfect solution? No, but it's a reasonable one.
And one of the reasons, of course, members are very differently situated, but in the instance where somebody perhaps owned individual securities prior to becoming a candidate or being elected, that would provide a divestment opportunity for that person who owns securities independent of any experience or knowledge they might have in Congress. But you touched on something else that is important, that is really the distinction between different types of assets. And if you would you describe for us the differences you see in, for example, a member of Congress owning individual securities as opposed to being invested in a mutual fund, and why that is something that is substantially different in terms of insider knowledge?
Yeah, well, if you're investing in a diversified mutual fund, there's essentially no risk, depending on what the fund is or how it's structured. So if you're, for instance, in a S&P 500 passive index fund tracking the stock market, then the only risk there is, well, whatever decision you make might make the stock market go up, but that's generally not the sort of risk people are worried about any more than when people were worried about Ross Perot running for president. He had a lot of federal government bonds. Well, if he actually got rid of the deficit, the value of those bonds would go up. But that people aren't worried about that sort of thing, right? So that's very different than you own stock in a particular company, and so there's going to be greater scrutiny. And you could have mutual funds that are very targeted or industry specific, and if you're on a committee that oversees an area where that would have an impact, that also could be something you'd have to worry about a little bit. But the broader the index, the more diversified it is, the less you'd have to worry about any sort of appearance of impropriety at all.
And you also noted a distinction between individual securities and assets that are placed in things like venture capital and private equity. Would you elaborate on why it is that those categories of assets and investments might need to be treated differently?
Yeah, the reason is it's hard to divest from very illiquid assets in many cases. So if you had an investment in a startup business, a venture capital, a private equity, where you have an illiquid security, and you had a divestment rule or a conflict of interest rule here that required a divestment within 90 days or 180 days, like many of these targets, It can be very difficult to unwind that. They're not going to be liquid assets. It's not clear who the purchaser is. It's very different than a publicly traded security. If you own Walmart or Exxon stock, easy to unload that, not going to move the market, and then you're mainly worried about the tax treatment. If you've got one of your special things, it's a little trickier, and you know, that's why you have ethics offices and things here. It's not that there's no potential conflict with those sorts of holdings, but a prophylactic divestment rule might be problematic.
Thank you, Mr. Chairman, I yield back.